So let's look at an example of the infinite banking concept in action. Here again is how we're contrasting infinite banking with conventional banking, where we can enable ourselves to earn on all of our capital even while we're spending it. So how do we do that? Well, simple. We're not going to withdraw our money when we want to spend it. We're going to take out a loan from our private bank. In other words, instead of withdrawing our money where it would stop earning for us, we're going to borrow against that pot of money and then strategically pay ourselves back so that our money keeps earning uninterrupted. And when I say borrow, we're not taking on debt. There's no credit check. There's nothing like that. This is a contractually guaranteed right that we're exercising because we're using our own private bank. We're not taking on debt. So how does it work? Well, we are going to use the contractual guarantees associated with cash value life insurance. Now, here is a real specially designed policy that I personally have designed, and I'm just showing you how this particular cash value life insurance policy grows over time. So as we pay premiums into the policy, you can see how your cash value grows from $19,000 to $241,000 to over $500,000 to $786,000 and eventually to $1.4 million. Okay, this is how cash value life insurance can be a savings account on steroids. So $1.4 million. That's what our cash value grows to if we simply pay our premiums and let the policy grow without ever using the cash. But what if we use the cash value that's in the policy? And what if we can use it in such a way that the policy growth is not interrupted? Well, let's look at that. Here's that same policy again with policy loans. So what we're going to do is we're going to pay premiums in. Our cash value grows from $19,000 to $241,000. And then we take out a $200,000 policy loan. So, and we're going to pay that loan back over time. So our cash value drops, our net cash value drops to $63,000. Our gross cash value doesn't drop at all because we didn't withdraw anything. Now, a policy loan is not a debt. There are no repayment terms on that loan whatsoever. That's important. There's no credit check, there's no nothing. It's a contractually guaranteed right. This is your capital. You have access to it whenever you want. And the reason why there are no repayment terms is because remember, this is a life insurance policy. That means there's a death benefit on the policy. And by construction, the death benefit is always more than the cash value. And therefore, if you don't pay a policy loan back, all that happens is the death benefit pays off the loan. So in order to simplify things here, I'm just showing the cash value, but there'd also be a growing death benefit on this policy as well. So our net cash value drops to $63,000 when we take out that policy loan, but our gross cash value keeps growing. Then as we pay back that loan, our net cash value goes up to $356,000, then up to $673,000. And then we're pretty much back to where we would have been had we never taken out a policy loan to begin with, 1.1 million and then 1.4 million. So by taking out a policy loan, borrowing against our policy, we did not interrupt the compound interest curve at all. Our cash value is the same regardless of policy loans. So the compound interest curve is uninterrupted even as we use the cash value. So by running our cash flow through specially designed cash value life insurance policies, our cash value grows uninterrupted even while we're using it.